Let's talk to Sam Hill. He's UK fixed income strategist at RBC Capital Markets. Good to see you, Sam. Can I just ask you first about that comment that slipped out from Moody's yesterday saying that they might reconsider the UK's AAA rating? We don't want to over-egg this, but it's the first time that that's been raised for a while.
It is the first time it's been raised for a while. I think that shows how well the government's done in rebranding the strategy for getting the deficit down since they took office just over a year ago. But I think it is important to note that Moody's did stress later that the outlook for the UK is stable at the moment.
And did it come... Sorry, I was just going to say, did it come after Osborne said that he may be a little bit more flexible on getting the budget deficit down? There might be a little plan B.
Well, I don't think at this time it is time for a plan B. I think it's worth remembering that there is 1 year's worth of wiggle room in plan A, and until that's used up, if indeed it ever does get used up, then I think plan B is really something we don't need to spend too much time thinking about. I think actually the most important thing from that series of comments and reports from the IMF and from Moody's this week is the risk to growth in the economy. The OBR's forecast for growth and what that means for the deficit assume growth of over 2.5% from next year onwards.
Sam, are you not concerned? Sure, the IMF says, look, the UK is doing a great job compared to other countries. Sure, you're putting the austerity measures in place. And then we had this letter, 50 top UK economists, just on Monday saying, you know, we're really concerned about growth because if you push the envelope too far in austerity measures, we're going to go to a double-dip recession.
Well, I think it's too soon to be talking about a double-dip recession. We have seen the PMIs come off, but they're still in positive territory. So what we're looking at is, a stumbling recovery, but a recovery nonetheless.
So no interest rates changes for at least the next couple of quarters?
Well, RBC have been forecasting since last November that the first hike from the Bank of England will come this November. And one of the reasons that we've had that call for a move later this year is that it would take that long for enough evidence to come through that the recovery was on track. And that's what we know now, that the bank, those sort of key members in the middle of the MPC, they're waiting for evidence that the slowdown in Q4 last year was temporary before they changed their mind.
Sorry, I was going to ask you then, therefore, about the gilt market and where you see gilts going. 10-year bonds extended a run of 8 straight weekly advances. Yeah. Where are they going?
Yeah, well, if you take the low of October last year when people were talking about QE2 and you take the high of February this year, just after the inflation report, when we were looking at 2 to 3 rate hikes at the end of this year, we're now much closer to back where we were in October last year. To my mind, for this rally to be extended any further and go back to those lows, you need the catalyst of realistic expectations of another round of QE. With inflation on the Bank of England's forecast heading towards 5% later this year, further upside surprises on that path for inflation coming out this week in terms of energy prices, it seems unlikely that unless you get another material lurch down lower in growth, that there's any realistic probability of more QE, in which case the market's looking reasonably stretched here.
All right, Sam, thank you so much. Sam Hill there.